Welcome, sir, to another series of podcast. Always good to have you. So the theme of today's podcast is about climate finance. So I know you have recently written a paper on it also. So I wanted to ask you a few things regarding that. First of all, if you think about climate change, the overall picture is that it's a global challenge. It's not just India, but everyone is getting affected by climate challenges. In India in particular, we have erratic weather patterns and no snowfall on hills, right? Forest fires, but this is happening all across the world. So it's a global challenge. So how do you see global partnerships, international collaborations actually shaping what we do as a country to address these?
Yeah, first of all, thank you for having me here. As you rightly pointed out, it's a global challenge. It's not a problem of one country. And developed countries have to take note of it, and they are quite aware. Of course, there are some issues which have been thrashed out, and this at a global level, I think they have been able to set some right goals to bring the climate change under control. And I believe if all countries they have their commitments under the Paris Agreement,
right.
If they continue to meet those commitments, there shouldn't be a problem. So where the collaboration can take place is basically technology transfer is two areas where I feel there is tremendous scope. One is of course climate finance, but in the case of climate finance there have been so many promises. First of all, there is no proper assessment of climate finance. The numbers which have come in from various studies, they are very large, but we have conducted a study on India as well as 9 emerging market economies, and those numbers are not suggest they are not all that large. The major reason for this is that no study has taken into account the saving of capital expenditure or saving of investment which you will be making when you abandon your spending on fossil fuel based sources of power or internal combustion engines vehicles. So if you make that kind of adjustment, your climate finance requirements are not large. But of course there are some other sectors which I have not come across any study which has taken into account the large requirement by the cement and steel. These are hard to abate sectors. So climate finance is one area, and technology transfer is another area. Take for example solar panels. They have come to play a big role. I think much has happened in this particular area, but there is another technology called carbon capture and utilization and storage, which basically is required as of now. This is the only technology with which you can abate hard to abate sectors, steel and cement. But this is very expensive technology. So the issue is that developed countries, they are not much producer of steel and cement now because they have already developed their infrastructure. So the problem is that for the developing and emerging market economies. So I'm not too sure really how far developed countries will be keen to focus on R&D, either to bring down the cost of CCS, so what we call CCUS, and or to look for alternative technologies.
Right.
So these are two areas. And the third area, of course, I also believe capacity building. There are many countries which don't have resources. There are many small vulnerable countries and they are highly indebted. So they don't have resources to first of all conduct some sort of analysis to understand
Absolutely.
what is the amount of resources they require, then how do they arrange those resources. And as I mentioned earlier, climate finance is one area where developed countries can do a lot, but the fact of the matter is that there is not much happening. Even multilateral development banks, their capacity is limited unless you expand their capital base, which is not happening due to some geopolitical reasons.
Right.
So unless you expand their capital base, it's very difficult for them to augment their lending capacity and then help emerging market and developing economies. So there are challenges, but I think if the leadership is committed of developed economies and they are keen to help developing economies, then I think that's the only way forward. But I'm not too sure how far that will be, because as I mentioned, there have been some challenges. Even the $100 billion every year, which developed countries committed in, at Copenhagen meeting way back in 2000. I don't remember exactly, but I think it was 2009 or so. That was to be completed in 2020, but I think that $100 billion was completed only in 2025. Of course, now there is talk about increasing that kind of commitment. So let's see. Yeah.
Right. So that's fascinating. Actually, it gives a good segue to dig deeper on few of these points. So, for example, there's very little that we can do on international response, but locally, nationally, how do you see, apart from government spending, how do you see private players participating in contributing towards climate change, or maybe regulators? So, for example, SEC has policies regarding climate disclosures, like few years ago we had for CSR. Right? So, do you see a role of regulatory bodies like SEBI or RBI in motivating climate disclosures, pro-environmental corporate behavior? Something of that sort that can help us reduce emissions, because the challenge is only going to get severe with AI. There is a lot of now demand for power, so and a lot of new capacity that we add, at least a part of it is thermal capacity. So half of what we burn is already coal, and it is going to only go up, right? So in this kind of a setting where power demand is only going to go up, can we actually, as a country, reduce our carbon footprint?
Yeah, it's a very interesting question, and it has 2-3 parts. Let me first handle the capital part, then we'll come to that fossil fuel-based sources of power. Insofar as energy is concerned, it's partly in the public sector, partly in the private sector. Insofar as road transport is mobility is concerned, railway of course is entirely in the government sector, and that 99% of I think railway has been already electrification has been done. And road transport, it's all private sector, other than the intercity. Local transport, I would say, which some corporations run. So like Delhi, they have buses, etc. So other than that, most of the mobility or road transport is in the private sector. Cement and steel, they are largely in the private sector, other than some steel plants, like SAIL is one of them. Most of them are in the private sector. So funding for climate change that has to come from the private sector. So government has a role, apart from that fact that they are in the where power plants are there in the public sector. But even you leave aside those areas, the government has a role to incentivize, greener technologies and encouraging people to to reduce the carbon footprint. And when it comes to that steel and cement sectors, there is a great need of incentivizing that. And I'm happy that this budget, which was announced by the finance minister 2-3 days back, there is a provision of some 20,000 crores of rupees for carbon capture and utilization and storage. Let me again mention here, I'm not talking much about utilization, because utilization of carbon capture is much more expensive than its storage. So I think it's better to focus on storage than on utilization at this point of time. So that's one part, that the government has a role, but the government role is limited only in incentivizing greener technologies. Now coming to this fossil fuel based sources of power. See, we are undertaking another study and we find that coal will install capacity in fossil fuel sources of power will peak sometime in 2031.
Okay.
After that it will start declining. We have already, whatever targets we have fixed, of course we have some target to be met by 2030. So we are doing a good job. The government has been very proactive and in developing renewable sources of energy. And so gradually the coal-based power, particularly its share will start declining from the early 30s. But the question then arises, what happens to the people who are employed there? And there are some states which are dependent on coal, like Jharkhand, Odisha, West Bengal. So what happens to those states? There is a question of employment as well as revenue losses to the government. So this is energy transition which will have to be well thought out.
Yes.
And then those plants which will not be used after some time. I think most of the plants still have long life. I think their typical life is from 25 to 30 years. So then now at some stage this question will arise, what do you do with those coal-based plants? Not now, sometime in future. So the government will have to give a thought to it. And I'm sure there's already seized of this issue. And then comes the private capital. We talked about the role of most of the funding has to be done by the private sector. And as I mentioned, capital requirements are large, but not as large as have been made to in the past. If you go by our study, the climate finance requirement for the power sector up to 2030 is only $57 billion.
Okay.
Because we have adjusted for the saving of capital expenditure, which we would have on fossil fuel based sources of power. And for road transport it comes to something like $17 billion. So, but this is only for the road transport, but as you enter the early 30s, because right now energy transition is taking place only easy use cases. The more challenging part will come later, and that's when the climate finance requirements increase sharply. Like after 30, climate finance requirements are going to increase sharply, and then if you take steel and cement, there will be huge climate finance requirements. So this climate finance requirement, again as a part of study, what we do, you can't mobilize these resources from outside the country, because there are limits to what you can absorb. If you get so many, so large capital inflows, it becomes a huge challenge to manage them. We can absorb to some extent, and one way to absorb more capital flows from other countries or from external sources is to expand our current account deficit. We have made some estimate that our current account deficit can be expanded up to 2.5% of GDP. So on an average last 20 years, it was something like 2% of GDP. So you have, if you expand your current account deficit, if you get large capital inflows for financing climate action, then we can certainly expand our current account deficit to 2.5% of GDP. And in case like as it is happening now, there have been capital outflows. If regular business as usual, what we call it, business as usual capital outflows, we expect capital inflows going forward. But if you don't get capital inflows to the extent we expect or we are projected, then you have room to absorb even more capital flows for financing climate action. So the point I'm trying to make is there are limits to arrange climate finance from external sources. So most of funding, even if you see today, whatever funding has happened so far, it is largely from 80-85% is from domestic sources, and that would continue to be the case in future. So how do you finance from domestic sources? There are two ways. Either you increase the saving rate, but then you need to know exactly what is your requirement. And the saving rate also, if it is not very large, you can manage. But if it's very large, then you increase the saving rate. But then you also reduce consumption, which has other macroeconomic implications.
Right.
So either you increase the saving rate, or you will have to crowd out other sectors. So, but it's very important to find out what is the saving investment dynamics of all the three sectors going forward.
Right.
Like government sector, household sector and the corporate sector. So basically there is need for a study, which of course we are another study which we are undertaking in CSAP. Like we need to understand the dynamics of all the three sectors. Absolutely. To find out what's happening to their saving investment behavior.
Absolutely.
And whether that can be financed without increasing even the saving rate. Because it's a very dynamic situation, keeps evolving. It's not like the situation you have 1 year, it can change next year. So, apart from assessing climate finance requirement, there is need for analyzing this kind of behavior. And the third thing, that this private capital for climate change, it's not easy to come because of the risk is involved. Banks are not ready to finance because they are not to finance that kind of projects. And even other investors, they are not very keen because of the risks involved. So that's where the role of mitigation comes. That you have to mitigate the risks in financing that kind of capital. And you must have heard about this thing, either credit enhancements or some blended finance, whereby the role where both private and public capital come into play. Then they mobilize, because that basically reduces the cost of capital. So that's the only way out. There are various ways to do that. I don't want to, depending on the time, I can elaborate on them. So the point I'm trying to make, that there will be need. So there are three things. One, assessing proper climate finance requirement. Second, analyzing the saving investment behavior of all the three sectors going forward, how that is going to evolve. And three, some mechanism to mitigate the risk in financing climate action for the private sector. Otherwise, even though a lot of money is there, that money may not come to finance climate action. Yeah.
It's always fascinating to hear about these tensions that are there in macroeconomics, because if you do this, then the other things get affected. All emerging countries, including us, have limited fiscal space. So if you spend in some sector, crowds out other sectors. If you try to curtail certain activities, it hits growth. So it's obviously very challenging. And also regarding flows, we can forecast whatever we want, but ultimately what happens to the flows is an uncertainty. Right? For example, in the last 1 year, there was a lot of FPI outflows. Right? So it's always a challenge to actually think about policies that can motivate private sector. So as you said, most of this investment has to come from private sectors. So just thinking out loud, but could there be policy initiatives that actually encourages this investment? For example, could you have green bonds raised from both private and public sectors, which maybe have a sovereign guarantee, or whether you have some tax subsidies for companies or corporates which are actually contributing towards this goal? Or can you tap in international markets on carbon credit? So I think already companies are doing this, and we also have this scheme now in India, the carbon credit trading scheme. So could these kind of mechanisms be leveraged to actually motivate Indian private sector to work towards this way? Because there's no natural inclination, as you said. It's expensive, uncertain, investments are not forthcoming. But it seems like it should be a policy priority for private sector. So what are your thoughts on that?
See, again, the instrument is not a challenge. Of course, it is a challenge to attract private capital to financing action. So you can create so many instruments that would not be a problem. So a bigger challenge is to have enough resources within the economy, including from external sectors, so which can then be channeled in for climate action. So it's not that if you have to undertake some project relating to this thing climate change, those will not be funded. They will be funded within the existing sources, but then the first problem will be whether the private investors who are going to invest, how are they perceiving their risk return? What is their risk return perception? And secondly, even if you are able to finance that, so if the resources are limited, then it will crowd out other sectors of the economy.
True.
So as I'm repeating my earlier point, it's very important to have on an ongoing basis, proper assessment of saving investment behavior of all the three sectors to first assess what is our exact requirement, and then whether we need to take some measures. I'm sure that private investors, although some investors may prefer the world is changing, we should be accepting little low, return to have a, green economy. But if you see the experience of the last few years, that the greenium, what we call it, green premium, that's not very large. So that means investors are not ready to forego their, or temper their expectation of return even on climate-related projects. So it's a big challenge. So the key thing is to have enough resources so that then funds flow seamlessly to climate-related projects. If resources are limited, like your investment requirement including climate change is much more than your domestic savings. And you take into account also the current account deficit. As I mentioned, your current account deficit, you can expand only to some extent.
Correct.
So even after you have absorbed that, then remaining requirements will have to be funded from domestic sources. If the domestic saving rate is much lower than what you need for all the investments in the economy, and then it's a challenge. Then you may finance climate-related projects, and some other projects will suffer. There is no fiscal space. If you have heard Finance Minister budget speech, we have now changed the fiscal anchor to debt to GDP ratio from gross fiscal deficit, and it is going to come down debt to GDP ratio this year from I think 56.1% to 55.6% by 0.5 percentage point. But for even if the target is to reach 50% by 2031, and this will require reduction in primary deficit. I have not seen, I don't recollect the number this budget, but year before, 24-25, it was 1.3%. It has to decline to 0.3% by 2031 in order to achieve the debt to GDP ratio. The point I'm trying to make is that there is no fiscal space. So the government role, again I'm saying, will be limited to providing the right incentives for greening the economy, and also to have framework like taxonomy. So we need to have, the government had issued draft framework, but that has not yet become operational because, and then the Reserve Bank has its own framework, SEBI has its own framework. I will come to now, you raised the question about SEBI, RBI. So SEBI has their own framework, RBI have their own framework. So I would feel there is need for one integrated taxonomy framework which is in line with the global standards, so that greenwashing doesn't happen, and the investor is very clear, like what kind of project they are financing. So regulators, you talk about the RBI and the SEBI, they have a role to play. Absolutely, they have a huge role to play. And the Reserve Bank has included I think investment in renewable energy up to rupees 35 crore as part of priority sector
Right.
lending. And there is also some incentive for individuals, but overall financing through this window is only something like 10,000 crore or so, which is not very
Right.
large. And the Reserve Bank has also introduced something like green deposits. Like again, that green deposits, whatever deposits are mobilized, will be used only for financing climate action. But again, that's very small. So banks need to be encouraged. So the Reserve Bank role, let me first describe about the Reserve Bank role. The Reserve Bank role, apart from what it has already done, I think it should encourage banks to be more, it needs to sensitize banks, which it has done, but it needs to be done on a much larger scale, so that they are forthcoming in financing such projects. Of course, they need to also build their capacity, because many banks have not financed those kinds of projects which are coming in the, if we are to reduce the carbon footprint and develop a green economy, they have never financed those projects in the past.
Right.
So there are challenges for them. So they need to build their own capacity, and the Reserve Bank has a role. Same is the case with SEBI. So by the way, SEBI has also I think they have a framework for debt financing for climate related projects. But I think there is also need for equity related. So because just as we talk about green bonds or green deposits or green credit, there is also need for green equity. So equity can also actually, the role of equity in financing climate action, because there the investors are ready to take risk. If they feel that the returns are going to be high in future, so they may take that risk.
Right.
So it's important that lot of green equity flows for climate related projects, and I think here SEBI has just as they have developed framework for for the debt, there is also some framework for green equity, so that investors can finance those projects. There will always be tensions, when climate action it requires a lot of finance, investment requirement. And this investment requirement is over and above what you need to do to develop your economy. And its problem is much more for developing and emerging market economies than for developed economies. Absolutely. So this is additional funding which you need. So the resources which you should have spent otherwise on other things, now you will have to make room for financing climate action. So there will be tensions. So that's why it's very important that we properly assess the requirements on an ongoing basis, and then work out a strategy how that can be done.
Fascinating, sir. Always good to talk to you and hear your thoughts. It was wonderful chatting with you in this podcast. Thank you so much.
Yeah, thank you. It was my pleasure. Thank you.
Thank you.
Yeah, thank you.